Well, hello, friends. How's it going? Happy Tuesday to you. Another busy week. Joining us on a replay. Happy replay day to you. And we're live, and I'm excited to see you. And as you know, you're part of the conversation. I'm so excited to have you part of today's talk because we're going to talk a lot about the financial markets. Let's get started.
Welcome to Level Up with Winnie Sun.
Hi, friends. I'm Winnie Sun, your host, Forbes Contributor, CNBC Council member, and award-winning financial pro here to keep you on top of relevant and trending business news. And more importantly, as you know, you're part of today's discussion, so we'll be monitoring your comments throughout the show because we love audience feedback. It's so much fun. Today we're going to start with a market update, and then we're going to jump into your questions because many of you submit questions to me each and every week, and I want to make sure that we address them. Let's start with the market. Let you know how it closed. Now, yesterday was a crazy day, as you saw, but today, did it continue? And in fact, it did. The Dow closed down an additional 50 points today. The NASDAQ, though, recovered a little bit, up 32 points, and the S&P 500 still down 3 points. Now, we may be wondering if the stock market parade has finally ended. Well, here's what we know so far. Yesterday, as you remember, was a total free fall day for the stock market. The Dow closed down over 900 points early, finally closing down over 600 points. Now, the S&P 500 did also close lower with its 50-day moving average following a previous tough week. And as you remember, Friday was pretty tough, breaking a streak that had held for the duration of 2021. In fact, this is the longest positive streak that we've had that ended since 1996. So it's pretty crazy. Here's what we do know, though. Stocks did roar back today. We saw that. They were up over 300 points for the Dow earlier today, but it closed down still pretty lackluster. So what do we know so far? Here's what we know so far. I wouldn't be in any hurry to jump back into the market too soon. Let's sit back and watch how this unfolds because the drama continues in Asia. The Asian stock markets were stable overnight. However, this helped our markets here in the United States. But as you know, the Chinese real estate developer Evergrande is not so grand anymore. In fact, China's Evergrande Group is on the brink of complete default. In fact, we're going to see what happens later this week because CNBC is reporting that they're due to pay interest worth $83 million this week on Thursday. Let's see if they actually do. So until that happens, I think we can all agree that being that we're a part of this global economy, what occurs in China and the Hong Kong markets will also impact the U.S. investor sentiment and how we decide and how quickly we decide to get back into investing once again. So we'll see. So tomorrow, there's other news that we want to pay attention to. And I think this is also why you saw today being kind of a much quieter day than yesterday, but also why people didn't jump back into the financial markets looking for bottom fishing. Because there's more news coming in the stock market tomorrow. All eyes are on Fed Chairman Jerome Powell. We want to hear news about interest rates, inflation, and pandemic easing, and much more to give us an indication of, in fact, if the United States is going to be okay. First off, it probably always will be okay, but if the financial markets will recover and continue to do well, that's what we're really looking for, especially those of us who are investors, right? So Powell said last month, if you remember, that he sees the Federal Reserve slowing its $120 billion monthly bond purchases at some point this year. So the question is it going to be sooner this year, or is it going to be at the end of the year, or is it going to come next year? So investors are really paying attention to this because we're really concerned about inflation. We're concerned about our Social Security. We're concerned about mortgage rates. We're concerned about so many things. So that's what we're paying attention to, and that's what we'll be talking about more in detail tomorrow. Now, on some positive news for those of you in New York City, you're getting a brand new, very hefty neighbor. So Alphabet's Google is making a monstrous acquisition in New York real estate. In fact, they're going to be moving to Manhattan. Today, they announced plans to spend over $2 billion to buy the St. John's Terminal building in beautiful Manhattan. And so they're really going to have a strong footprint now in New York. I'm excited. The next time I go to New York City, I don't know when that'll be, I'm definitely going to check this building out, maybe go see some friends in the Google building, the future Google building. I guess it won't be anytime soon, because Google also shared on their blog post that this structure, this massive new construction, will be the anchor of their new Hudson Square campus. Now, when will this happen? This will probably be ready, open, maybe to employees and visitors and whatnot in 2023, giving them plenty of time to build this monstrous building in Manhattan, I guess, next year. Question is, when will they get employees back into this space? And what I'm really curious about, I'm guessing you're curious about too, is what sort of COVID provisions are they going to be making in this new space as well to make sure it's the workplace of the future? Now, Alphabet, Google, you may have seen, or is already over 14% over the last 3 months. So they continue to do well during this time. Now, let's segue to your questions, because today we're going to do a special Tuesday edition of Ask Winnie Anything. All right. So you had a lot of questions this week. We selected a couple in the interest of time. So let's go with this. Okay. So, hey, Winnie, my partner and I just got hitched after dating for years. Congratulations. I love it. Wedding. What are the best tips for combining finances? All right. Great question. Let's jump right to it. Now, many of you have wondered this, and I've been asked this question so many times over the years. Let me tell you, working with so many different clients and businesses and employees and doing speaking on this topic, this is what I think is actually the ideal starting point. I think most couples should have what I call the you, me, and we portfolio strategy, meaning that you and your partner should have individual accounts. Like this could be investment accounts. It could be your banking accounts, your finances, your typical, check writing. You should have your own money. Some of your own money, and then you should have together money. And the together money could be a checking account, could be an expense account. This money can be used to pay your normal expenses. This can also be money that you save together for a future new home, for a future vacation or whatnot, something that you both contribute to. But I'm a big believer in the me, you, and we strategy, because I will tell you, with how many clients I've counseled through the years, I would say vast majority of happily married financial clients tend to have this sort of equation. So let me know what you think. For those of you who are following me, I see Tip, I see Sadiq. Hello, Vicky. Thank you all so much for being here, part of the show and joining us live. Don't be shy. If you're watching us live, tell me where you're joining us from. I love to get to know you as well. Let me know if for those of you who are married, or if you're in a relationship, in your partnership, how do you best structure your finances? Do you agree with my question to this viewer here? I think you, me, we, that's how my husband and I do it. And it works out just fine. Eventually, you're going to have your own investment accounts. You're going to have your own retirement accounts. And everything has to be there together. I think the little bit of, having that freedom of making your own financial decisions makes a lot of sense. All right. Let's see your next question. Thanks so much, by the way, for submitting that question. All right, Winnie, what does it mean to barbell your investment portfolio? It's interesting you asked this question. I think it must have been shared on social media recently, because I had several people ask me this question the last couple of weeks. Now, the barbell strategy is actually sort of an investment concept. We've used it many times talking to clients, advising them how to manage their own money, how to structure their investments, like making sure to mitigate risk and making sure that they have exposure in many different sectors and making sure that the money is diversified. So this strategy talks about the importance of strategies, sort of having balance between growth and value, having things that are a little bit more aggressive and things that are a little bit more conservative. And this is how I explain it to you. This is how I was taught it years ago when I first started in the financial industry. Imagine yourself being on a boat, right? And you're crossing the ocean, whatever this ocean may be. Would you fill the boat up? Let's say you were in charge of selling fine wine, right? Would you fill the boat up completely of fine wine? Maybe you would, right? Because you could maximize your sale when you got to the end of the destination. But what if during this time you weren't completely sure whether you would make that destination? There were still odds of risk, right? There was like the potential of hurricanes and natural disasters, and maybe you weren't quite as technology advanced as you are now. This is back in the day. Well, then you might decide to fill the boat up with half wine and half bottles of water to mitigate your risk, right? So that way, if something went down, you didn't lose all your money. Like half of it would be in something very valuable, something else less expensive that could balance out your risk. That's the concept of the barbell strategy. So when you invest in the portfolio, perhaps you're more of a moderate investor, perhaps you're a little bit more risk averse, perhaps you don't want to, risk so much of your hard-earned dollars. Then you would consider a barbell approach of things that are a little bit more aggressive and things that are a little bit more conservative. Now, thank you so much for asking a question. I hope that makes sense to you. But that's what investment professionals are talking about when they talk about that type of investing. It's kind of like sort of going sort of the middle of the road, trying to get that balance into place. Now, if you have other questions like that, maybe you've heard other terms, you have other questions on how to really take advantage of certain business opportunities or taking advantage of how to speak to your employer, finding that next perfect position for yourself or looking for flexibility, submit your questions, whatever they are, as long as they start with a dollar sign. I'm happy to look at them. And of course, when you share, you care and you help those who are watching get their questions answered as well. So thank you so much, my friends, for submitting those questions. And thank you so much for watching and supporting our program. Take a moment to share this show with someone that you care about. And if you have questions and you want to reach out, don't forget, any social media platform that I'm on, send me a question, send me a direct message. I'm really active on Twitter. You can definitely send me a direct message there. It's always open for you. So I love to hear from you. And as a reminder, you can find full episodes of Level Up on NASDAQ, Amazon Fire, and Roku. So be well, and I can't wait to see you again this week. Take care now.